Pursuant to the governor's executive order to avoid gatherings of more than 10 and the governor's March 16, 2020 suspension of certain provisions of the Texas Open Meeting Act, the August 18, 2020 meeting of the School Land Board is being held today by video conference call, as authorized under Texas Government Code Section 551, Tech 125. Access to the meeting by members of the public was published in advance in the Texas Register in accordance with the Texas Open Meetings Act. Any members of the public who wish to address the board on a matter within the authority of the board should indicate so at the start of the meeting or during any public comment period. Chairman may limit the length of time available to each individual. I believe Corey will be hosting those that wish to comment via chat and or Q&A for the general public. And with that, we can go ahead and begin today's August 18, 2020 School Land Board meeting. First on the agenda is approval of the minutes from our last meeting on June 16, 2020. After the board has had a chance to review and assuming no questions, objections, or comments at this time, I can entertain a motion to approve the minutes for the record.
So moved, Commissioner.
Second.
Motion is made, seconded, and carries unanimously to approve the minutes. Next item on the agenda is the approval of the consent agenda. It has been related to me that items number 2A12, 2A13, 2A14, 2A15, 2A17, and 2C8 have been pulled from the docket prior to the meeting. Notwithstanding the foregoing, if anybody has any questions, comments, or objections, or if there's any questions really on the consent agenda as it is posted, feel free to ask. But otherwise, I can entertain a motion to confirm item number 2.
So moved, Commissioner.
Move to approve.
Second.
Motion is made, seconded, and carries unanimously to approve the consent agenda with the removal of items 2A12, 2A13, 2A14, 2A15, 2A17, and 2C8. Next on the agenda is consideration of our online deal that we got with EnergyNet. Mr. Hatter.
Good morning, Robert Hatter with Energy Resources. Yes, EnergyNet Services LLC currently provides online services for conducting the oil and gas lease sales for the School Land Board. That contract expires on August 31st of this year. Staff is requesting that the board approve an extension of the contract with EnergyNet for an additional year starting September 1, 2020. It would be under the same terms and conditions of the existing contract with EnergyNet. EnergyNet would continue to provide online services performance of the lease sale at no cost to the state. Since EnergyNet's done a great job, but since we've been with them for 5 years now, staff will initiate an open market solicitation to see if there are any other services, some competing services, and we'll review that. Once we get those, before we do anything else, we would come back to the board, and staff recommends approval as submitted.
Mr. Hatter, this is Todd Williams. I have a quick question for you, if I could.
Yes, sir.
Since you said there's no cost to the state, how is EnergyNet actually compensated? Where do they receive their remuneration from?
They receive that from the bidders. They have a buyer's premium between 1% and 1.5%. It's based on the size of the bid. The larger the bid, the lower the percentage, and that is by the winning bidder.
Okay, thank you.
Yes, sir.
Hey, Robert, do you anticipate other firms that can step up or that have managed state minerals or a portfolio like ours?
I'm not aware of any, Commissioner. Most of the other states, as well as the BLM, use EnergyNet. I know Colorado, North Dakota, Utah, they all use EnergyNet. I'm not aware of any other state using any other service at this time.
Any other questions from the board?
No.
None here. I'll move to approve.
Second.
Motion is made, seconded, and carries unanimously to approve item number 3. Next on the agenda is number 4.
Good morning. This is Amy Nunez with Coastal Field Operations. Item 4 is consideration of possible action related to authorization to repair or rebuild cabin permit structures that were damaged by Hurricane Hannah. On July 25th, 2020, Hurricane Hannah made landfall about 15 miles north of Port Mansfield, Texas. It was a Category 1. It did have maximum sustained winds of about 90 miles an hour. And although this is a remote area of the Texas coast, Hannah did have impacts, specifically to the cabin structures in the Laguna Madre. These are authorized under Chapter 33 of the Texas Natural Resources Code. So following the storm, staff completed a little over 200 cabin inspections of the area where the storm, the path and vicinity of the storm. They did identify 15 cabins that were destroyed in excess of 50%. These cabins are all located in Kennedy and Willacy counties. Most of them are actually in Kennedy County. There's only one in Willacy that was identified. Chapter 33 of the Natural Resources Code does state that if a structure is destroyed severely by any means, then no major repairs can take place until they have approval from the board. So at this time, staff is recommending the board to authorize the rebuilding of these cabins provided in their permit in accordance with Chapter 33 of the Natural Resources Code. Staff is recommending that all repairs be completed by July 25th, so 1 year of the storm of 2021. We do request authorization to allow additional time to perform these repairs on a case-by-case basis as needed or as circumstances warrant.
Any questions from the board at this time?
No.
I may have asked during briefing, Amy, on staff capability of monitoring repairs and whether or not they will be in compliance, because, you know, I'd hate for lessees to expend significant amount of capital and not be in compliance with a repair. Do you think we're in a position to provide proper oversight?
Yes, I think so. Most of the, we've had contact back and forth with the impacted permit holders already, and most of them are very aware of the rules. We'll, as soon as this is approved today, we'll send out information immediately, letting them know of the timelines and requirements. The cabin permit holder group as a whole is a very compliant group. They value their structures and take their permits very seriously. So we typically don't have many compliance issues, and then we'll work with them on a case-by-case basis. I know a lot of them may want to do modifications or change things, and so as permit holders want to do that during this repair period, we'll bring those before the board so they can be individually approved, reviewed and approved for any changes they may want to make to the structures. We're also working to have dumpsters out there, something that was actually planned before the storm, and hopefully that can even be increased a little bit to provide places for permit holders as they clean up these structures to place debris and materials to help them with this process.
Any proposed motions from the board to approve staff recommendation?
So moved.
Second.
Motion is made, seconded, and carries unanimously to approve item number 4. Next item is on a similar topic.
Yes. So item number 5, again related to Hurricane Hannah with regards to a timeline for repair and rebuild of pier structures that were damaged by the storm. So similar to the cabins, there were piers, mainly residential, that were impacted by Hurricane Hannah. Most of these structures are located again in Clayburgh County. There were some in Nueces and Aransas County. More specifically, the Baffin Bay area, including Cayo de Grillo and Laguna de los Olmos. We did also have some damage to piers in Corpus Christi Bay, Laguna Madre, and Aransas Bay, but again, the majority were in the Baffin Bay area. At this time, staff has to date identified a little over 200 pier structures that was damaged over 50%. These again were authorized under Chapter 33 of the Natural Resources Code. As I mentioned, most of these are residential. They're authorized with either a coastal easement or a structure registration. And in a lot of cases, peer repair has already begun in accordance with their respective contracts. There were a few commercial structures damaged by the storm, and they must also rebuild in accordance with their contract. And of course, any modifications to those approved footprints do require board approval. At this time, staff is recommending that all repairs be completed, again, with the 1-year timeline of July 25th, 2021. Staff also requests the ability to authorize additional time to perform these repairs, and that be granted on a case-by-case basis as circumstances warrant. We do recognize, especially with these residential piers, that funding, contractor availability, and other potential storms are just some of the factors that can affect these folks as they work to rebuild their individual piers.
Any questions from the board?
Move to approve.
Second.
Motion is made, seconded, and carries unanimously to approve item number 5. Thank you for that, Amy.
Thank you.
Next item on the agenda is number 6.
Good morning, Commissioner and members of the board. Andrew Hawkins here, staff attorney in the Office of General Counsel. We are back before you today to seek adoption of amendments that were proposed and brought before you at your May meeting. This is to clarify and streamline a few instruments authorizing the use of coastal public land, specifically the sections involved for which we are seeking final adoption of amendments are 155.1, 155.2, 155.4, 155.5, and 155.15. And just as a brief recap of the specific changes, these are to first coastal leases, public coastal leases, and the renewal process. The second change is to cabin permits, and to clarify that transfer of cabin permits is authorized under existing board practice and policy, provided conditions of the previous cabin permit are met. The third change is to structure registration recording. This is just altering the sequence of when that requirement falls within the structure registration process, changing it from before the application is submitted to after it is issued. And the last change is to coastal easement, specifically riprap only projects. This is to resolve an inconsistency in the fee tables regarding charging for riprap only or vegetative cover only projects. And it simply clarifies existing practice that if the project consists only of riprap or vegetative cover, there is no charge. So on the whole, again, these amendments are all minor in scope, and the main intent is to clarify and streamline the administration of these instruments. And they were published in the June Texas Register for a 30-day public comment period. There were no comments on the proposed changes. And again, staff is seeking recommendation, staff is recommending final adoption of the proposed changes and filing a notice in the Texas Register. I'm also here with Tony Williams and Amy Nunez from Coastal Field Operations in case there are any questions.
Any questions from the board at this time? Could entertain a motion to confirm.
I so move.
Second.
Motion is made, seconded, and carries unanimously to approve item number 6. Thank you, Andrew.
Thank you, sir.
Items number 7 through 12 will be held in executive session. We'll enter into it pursuant to Chapter 551, Subchapter D, Section 551, Tech 071 of the Texas Government Code. for discussion regarding potential litigation and or settlement offers, and to seek or receive attorney advice related to items 7 through 12 on the docket. Also entering into executive session under subsection 551.072 for discussion and consideration concerning purchase, sale, exchange, lease, or value of real property related to items 7 through 12. Following executive session, we'll reconvene in open session to complete the docket. I ask that visitors remain on the Zoom call. Board members will return to the Zoom call following executive session. We'll connect via conference line in the number and data that's been provided in your packets. And we'll be back in open session in a minute. We have our board members back. That means the open session will now resume with item number 7.
Good morning, Amber Long, Asset Management. Staff recommends approval of the disposition of tax foreclosure land for the terms discussed in closed session. Any questions?
This is Michael. I move
Just before we can take a vote,
Oh, sorry.
Corey says that Todd is muted, so we need, I guess, Corey, if you can you
I'm unmuted now. They just
unmute him? Okay,
Thanks.
great. Is there a second to the motion?
Second.
Motion is made, seconded, and carries unanimously to approve item number 7. Next item on the agenda is number 8.
Good morning, Amber Long, Asset Management. Staff recommends approval of the disposition of permanent school fund land for the terms discussed in closed session. Any questions?
No.
I move to approve.
Second.
Second.
Motion is made, seconded, and carries unanimously to approve item number 8. Thank you, Amber.
Thank you.
Next item on the agenda is number 9 in Reeves County.
Good morning, Amber Long, Asset Management. This is excess acreage in Reeves County, and staff recommends approval of the disposition of excess acreage as being in the best interest of the permanent school fund for the terms discussed in closed session. Any questions?
Move to approve. It's Michael.
Second.
Motion is made, seconded, and carries unanimously to approve item number 9. Next item on the agenda is number 10.
Thank you.
Good morning, Susan G. Garrett with Asset Management. Number 10 is a disposition of permanent school fund land in Harris County, file number 035795. Staff is recommending approval of this sale according to the terms and conditions discussed in executive session. Any questions?
Move to approve.
Second.
Motion is made, seconded, and carries unanimously to approve number 10. Thank you, Susan. Next item on the agenda is number 11.
David Wells with Asset Management. Staff is recommending approval of docket item number 11 per the terms discussed in executive session.
Any questions from the board? Can entertain a motion to approve.
Move to approve.
Second.
Motion is made, seconded. I will abstain from the vote as I abstained from the prior agenda item related to this particular tract in Bexar County. Scott, are you voting in favor?
Is this the San Antonio deal?
Yes, Bexar County.
Yes. I would like to abstain from this vote, please.
Okay, I have checked with council. We can, the item still carries because we have a quorum at 4, 2 votes to approve with 2 abstentions. So item number 11 carries. Next item on the agenda is number 12.
Commissioner, I'm sorry. I don't know if we did we have a motion and a second on that with the 2 board members?
We did. We had a motion.
Okay.
We had a motion from Todd Williams, and then Scott voted a second. So I'm assuming that they voted in favor of the item.
I think Mike.
No, Scott did not second.
No, that was me, Commissioner. It's Michael.
Oh, yeah.
Well, I'm sorry. I got the names confused. Michael seconded, and Scott and myself will abstain.
Thank you, sir.
Next item on the agenda is number 12.
Thank you, Mr. Chairman. Members, for the record, I'm Rusty Martin, Chief Investment Officer of the General Land Office. Approval of this item would constitute your approval of an increase in the amount of an existing capital commitment to NCAP Energy Transition Fund 1 LP. As you'll recall, in November of 2019, you approved a capital commitment of $200 million to Fund 1. The IAC is recommending that you increase that existing $200 million capital commitment by an additional $100 million, which would result in a total capital commitment to Fund 1 of $300 million. As a reminder, Fund 1 is a $2 billion closed-end commingled fund sponsored by Houston-based NCAP Investments, which is a leading energy investment management firm. Taking advantage of a competitive renewables cost structure and rapidly declining battery prices, Fund 1 is making privately negotiated equity investments focused on opportunities created by the global transition to a lower carbon energy system. Texglo has a longstanding relationship with NCAP that began in 2007. In addition, we have a longstanding relationship with NCAP Flat Rock Midstream, which began in 2008. The original proposal for the fund was presented to and discussed with investment management staff and the Townsend Group in meetings and conversations between June and October of 2019 by NCAP principals and the Fund 1 team. In addition, investment management staff and Townsend subsequently performed due diligence on the fund during August through October of last year. And then NCAP principals and the Fund 1 team members made a detailed presentation to the IAC in Townsend on October 30, 2019. Since the original $200 million capital commitment in November of last year, the fund has been actively pursuing investments in the renewable energy battery storage investment space. A June 2020 virtual due diligence session with NCAP, the Fund 1 team, and other potential limited partners highlighted the very attractive investment opportunity set that the team is currently pursuing. In light of the success that the team has had in pursuing investments, even during this COVID-19 pandemic, and the attractive investment opportunity pipeline that they're currently evaluating, an IAC meeting was held on July 21st of this year to consider an expansion of the existing commitment to Fund 1. In conjunction with that diligence, discussion, review, and analysis, investment management staff worked with Townsend and legal counsel to ensure that an expansion of the existing Fund 1 investment fits within the framework of the Texglo PSF investment policy statement and is in the best interest of the permanent school fund. Therefore, the IAC is recommending that School Land Board approve an increase of $100 million in its existing investment in NCAP Energy Transition Fund 1 LP, resulting in a total investment of $300 million by the School Land Board in Fund 1. And I would note that as is typical, the approval of this transaction is ultimately dependent upon the negotiation and finalization of any documents that would be related to the proposed additional investment in the fund. And I'm happy to answer any questions, Mr. Chair.
Questions from the board at this time?
None here.
Could entertain
None
a
here.
motion to approve Rusty's recommendation.
I move to approve this, Michael.
Second.
Motion is made, seconded, and carries unanimously to approve item number 12. Next on the agenda is number 13, consideration for the release of funds from the real estate special fund account.
Thank you, Mr. Chairman. Members, again, Rusty Martin, Chief Investment Officer. This item affords the board with the opportunity to consider the release of funds during fiscal years 2022 and 2023 from the real estate special fund account, which I'll refer to as the RESFA, to either the available school fund or to the State Board of Education for investment in the permanent school fund. As you're aware, the Natural Resources Code, section 51.413, authorizes the board to release funds from the RESFA to either the ASF or to the SBOE for investment in the permanent school fund. And then further, Title 31 of the Texas Administrative Code, Section 151.6, requires that the Chief Investment Officer of the GLO perform an analysis regarding the potential release of money from the RESFA by July the 31st of each even-numbered year, provide the results of such analysis to the board, and make recommendations to the board concerning the potential release of money from the RESFA. Accordingly, I have performed the analysis required and described by Title 31. And the results are shown on page 1 of the memo that you have. The amounts available for release in 2022 is $415 million. The amount available for release in fiscal year 2023 is $460 million, for a total of that 22 to 23 biennium of $875 million. By way of putting that in context, with the amount that was approved for the 20 and 21 biennium, that amount was $655 million. 600 of that went to the available school fund and 55 of that went to SBOE. So the 875 that the analysis has indicated this time represents approximately a 34% increase over the amount that you approved in 2018 for the 2020 and 21 biennium. The administrative code also provides flexibility to the board to determine, and I'm quoting here, the actual amounts to be released to either the ASF or the SBOE for investment in the permanent school fund in each of the individual years of the next approaching fiscal biennium and the actual dates of the releases. To help you in looking at this, I've created a spreadsheet which should be attached to your memo. It describes several of the many options that are available to the board when considering this decision. So at this point, I'm going to recommend that an amount of $875 million be released from the RESFA during fiscal years 2022 and 23 to either the ASF, the SBOE for investment in the permanent school fund, or some combination thereof as determined by the board. I'm also going to recommend that the total amount of each release be completed in 4 equal quarterly installments of each approved annual amount during each of the fiscal years 2022 and 23. I am happy to answer any questions. This is your decision about how much to release and how to split that amount. Thank you, Mr. Chairman.
Thank you, Mr. Martin. Any questions from the board at this time as we consider the staff recommendation?
This is Todd. Is there any reason that I'm not thinking of why we wouldn't just distribute it straight to the ASF? Is there any consequences to doing that negatively is a detriment to the public education and kids of Texas? If not, I would recommend just going straight to the ASF unless there's something I'm not thinking through.
Well, at this stage, I mean, I'll jump in there. I mean, I think we have a great partnership with the State Board of Education following last session and early indications based upon not only our joint open meeting that we had with them, but in conversations that we've received, there are indications that they are looking at a historically large release of their own directly to the ASF. Mm-hmm. And so in combination, you know, with this release, this decision that we make today, it could very well be in the ballpark of north of 2.5 billion released to the ASF directly between our two entities. So it's in that spirit that I think we would release directly to the ASF and not directly to the SBOE. Their endowment is performing very well, very capable staff. And so, you know, knowing that our two boards are going to be called upon for this upcoming biennium, when you look at it in that context, I think it's actually a great partnership for us to be able to plug a very large hole in the budget.
I would echo your comments about the spirit of partnership with the SBOE. I think it's great that we're operating this way, and I hope that we continue it. And so I would recommend that that distribution as well. I know they're trying everything that they can to make sure that they can help the budget and help kids in Texas this coming biennium.
Any other questions or comments from the board?
I will move to approve to adopt the recommendation of staff.
Just to be clear, I think we should go for option A, which is the 415 in fiscal year 22 and fiscal year 23 would be 460 million. Or we can go based upon any other, agreeable release timetable.
Does Todd have a motion on the table?
I'm happy to amend my motion to be for option A, 415, and was it for 415 in year one, and all of it going to the ASF.
I'll second that.
Motion is made, seconded. I would vote in favor of that motion. How about you, Michael?
I'm in favor as well. This is Michael. I'm in favor.
Excellent. That makes the vote unanimous in support of option A. Thank you for that, Rusty.
Thank you, Mr. Chairman, members.
Next item on the agenda is number 13.
Thank you, Mr. Chairman, members. For the record, Rusty Martin, Chief Investment Officer. This is a non-voting item for information only. I'm pleased to present you with the quarterly investment report of the Texas Globe Permanent School Fund investment portfolio for the period January 1st through March 31st, 2020. The performance measurement calculations and the statistical data that are presented in the report were prepared by State Street Bank and its private edge group, which serve as the custodial, accounting, and performance measurement agents for the portfolio. Starting with a brief summary of markets. All I can say is, wow, what a quarter. First quarter US GDP decreased at an annual rate of 5%. It was a negative 5% following an increase of 2.1% for the fourth quarter of 2019 and an increase of 2.3% for all of 2019. And of course, that dramatic decrease in GDP reflected the response to the COVID-19 pandemic and reflected the fact that governments had issued shelter-in-place orders in March, leading to rapid changes in demand as businesses and schools switched to remote work or canceled operations, and consumers canceled or redirected their spending. You might also note that the U.S. unemployment rate ended the quarter at 4.4%, up dramatically from 3.5% at the end of the fourth quarter of 2019, and also reflecting the early effects of the pandemic. In response to the effects of the pandemic on the economy, the Federal Reserve began taking actions designed to ameliorate an approaching economic crisis. At an unscheduled March 3rd meeting, the FOMC, citing the quote, evolving risks to economic activity, end quote, associated with COVID-19 pandemic, lowered its target Fed funds rate range by 50 basis points from 1.5% to 1.75%, all the way down to 1% to 1.25%. And then less than 2 weeks later, at another unscheduled meeting on March 15th, they lowered it even more dramatically, all the way down to 0% to 0.25%, the 100 basis points differential. They also indicated that they would maintain that target rate range until, quote, they were confident that the economy has weathered recent events and is on track to achieve its maximum employment and price stability. goals, end quote. In addition, they also reaffirmed the continuation of the balance sheet normalization program that they started in October 2017. And they also stated that they would continue to monitor the implications of incoming information, including public health information, and would use any tools at their disposal in the manner required to support the economy. In addition, the timing and size of future adjustments in the Fed funds target range will depend upon their assessment of, quote, realized and expected economic conditions relative to the maximum employment objective and symmetric 2% inflation objective. Moving to the markets in which we invest, starting with the commercial real estate market, as measured by the NCREIF Property Index, which I'll refer to as NPI, it returned 0.71% for the quarter, basically flat. That was the lowest return since the fourth quarter of 2009, which, as you recall, was in the midst of the financial crisis that led to the Great Recession. The trailing one-year return was 5.28% for NPI. Overall occupancy rates were relatively unchanged at about 94% in the quarter, although hotel occupancy decreased significantly. However, it is important to note that occupancy is based on space under lease, regardless of whether rent is actually being collected. Therefore, it's probably too soon to determine the extent of the impact of the pandemic on the occupancy levels that are reported to NCREIF. Probably in the second quarter, we'll have a more clear picture of what that looks like. As far as the returns for each of the individual sectors during the period, hotel was down 3.69%, retail was down 2.06%, apartment was up at just under 1%, 0.95%, industrial was up 2.58%, and office was up 1.28%. Industrial, once again, the best performing sector by far during the quarter, and of course that's due to the continued strong performance of industrial warehouse space. Energy markets, wow, tremendous volatility, huge price swings during the first quarter. WTI spot prices averaged just over $45 a barrel during the quarter, but they ended the quarter at about $20.50 a barrel. It was a 60% decrease from the fourth quarter ending price of around $61 a barrel. As you know, that decrease was really the result of an economic disruption caused by the COVID pandemic, further compounded by higher Saudi Arabian production output. This increased output was in retaliation for Russia's unexpected early departure from the OPEC Plus meeting in March, before the members could agree upon a mutually acceptable production cut. This unprecedented simultaneous combination of vastly increased global supply and drastically reduced global demand has resulted in the most significant oil market imbalance since the discovery in 1930 of the East Texas oil field that coincided with the Great Depression. Subsequent to quarter end, quickly filling global storage and fears of a prolonged demand disruption associated with the pandemic led the industry to begin slashing drilling and production activity. The U.S. rig count reduced 42% and CapEx budgets reduced about 30%. More cuts are expected in both. During the rest of this year, oil prices are going to be driven by the pace and magnitude of any global demand recovery, and global stimulus and human behavior will be the key factors in the ultimate outcome. As far as natural gas prices are concerned, they averaged $1.90 per million BTUs during the quarter, but ended at just over $1.70. That's about 17% below the fourth quarter ending price of $2.05. Of course, we had a much warmer than expected winter, again compounded by the pandemic demand destruction, and those all exerted tremendous downward pressure on gas prices during the quarter. This is the second time since April 2016 that natural gas has traded below $2 per million BTUs. Most industry analysts are forecasting that gas will sort of hover in the $2 range in the near term. Time will tell. Moving to the performance of the portfolio on page 2 of the report, you can see that the total NAV of the portfolio at the end of March was just over $4 billion at $4.051 billion. The portfolio itself was $3.7 billion or 91%, and the cash was just over $300 million or 9%. Looking at the returns, it was a rough quarter for the portfolio, as I'll get into in detail. Gross return for the quarter was minus 13.11% versus a positive 1.2% on the benchmark. As we've talked about in the past, the benchmark, 2/3 of our benchmark is based on CPI plus a spread of 300 basis points. So except in periods of deflation, we're always going to have a positive benchmark in which we measure against. So when we're in situations, environments like these, where we have these negative returns, we will almost always underperform the benchmark. During the period, the sector, the real estate sector was basically flat. It was up 0.65% for the quarter. Infrastructure was down at 5.98%. Energy was down dramatically at 30.07%. 1-year returns, not much better, minus 13.72% for the portfolio versus positive 5.06% for the benchmark, reflecting what I was talking about a few minutes ago. The 1-year sector returns, energy down 38.33%. And of course, we've talked about the reasons for that: price volatility, huge price decreases, high amounts of supply, very low amounts of demand. Infrastructure was a positive 1.19% for the 1-year return, and real estate was up 7.95% for the 1-year return. 3-year return for the portfolio was 3.73 versus 5.89 on the benchmark. But then once we move into the longer term measures of 5 and the 10-year, you see that the portfolio outperformed significantly on that basis. 5-year return on the portfolio was 8.76% versus 668 on the benchmark. So an outperformance there, just over 200 basis points. And of course, the 10-year return still remains outstanding at 13.38% on the portfolio versus 9.41 on the benchmark, about a 400 basis point outperformance there. At the end of the quarter, about 35% of our total existing capital commitments remained unfunded. That was about $2.9 billion. 30% of real estate remains unfunded, 38% of infrastructure, and 36% of energy. As far as new investments are concerned, there were no new investments during the first quarter, and there also were no new capital commitments during the second quarter. As we have talked about, the fundraising activities of many investment managers has been slowed dramatically or even curtailed in some instances due to coronavirus pandemic. We expect, at least anecdotally, we expect that you will see that fundraising activities begin to increase sometime this fall and towards the end of the year. As far as portfolio allocations are concerned, looking at page 7 and 8, based on a pure invested or net asset value basis, the allocation to real estate at the end of the quarter was 32% versus the 33% target. Infrastructure was at 38% versus a 32% target. And energy, as you would expect, given the write-downs, was well below its target of 35%. It came in at 30%. And of course, these allocations will change over time. They currently reflect extreme levels of volatility in energy markets. But over time, they should become more aligned with our policy targets as the board makes new capital commitments and as more of the existing unfunded capital commitments do become funded. On page 8, you can see the allocations, looking at it on an invested plus unfunded commitments basis. And on that basis, real estate was at 28% versus a 33% target. Infrastructure was at 38%. Energy was at 34% versus its 35% target. As far as geographic diversification, on page 11 and 12, you can see the portfolio is very close to its targeted geographic allocations, with 93% of the portfolio invested in the US compared to a target of 90%, and the international allocation at 7% compared to a target of 10%. Moving to the investment manager exposure, which is shown on pages 13 to 14 of the report. Portfolio is well diversified across a platform of 25 different investment managers. We have a limit in a policy statement to no more than 20% of the total portfolio invested with any one investment manager. At the end of the quarter, we're well within that range. The top 5 highest exposures are USAA Equity Advisors at 10.16%, InCap Flat Rock Midstream at 9.54%, Macquarie Infrastructure Partners at 8.46%, InCap Energy at 6.29%, and Clarion at 6.18%. Co-investment vehicles are grouped by manager and presented separately. The highest grouped co-investment exposures at the end of the quarter were InCap Flat Rock Midstream at 7.77%, followed by First Reserve at 5.51%, and BlackRock at 4.26%. That concludes my presentation. As I mentioned earlier, this is a non-voting item, but I'm happy to answer any questions you may have.
Any questions from the board of our esteemed CIO? Not hearing any. Go ahead. Sorry.
Oh, this is Todd. The marks are as of what date, Rusty?
March 31, 2020.
Okay. And what have you seen in energy pricing in the subsequent quarter? Or since, you know, how would we expect marks to look at the end of June if you had to make a guess?
Yeah, I don't think there's going to be much change. Oil did make a recovery through the second quarter and is trading now around $43 a barrel, and it's sort of been in the $40 barrel range for a fairly significant period of time. You know, that could change, of course, but I think what you're getting at is how aggressive were they in taking those marks in the first quarter, and I think the answer to that is they were pretty aggressive in writing those valuations down. I don't expect the second quarter would see that kind of degree of write-downs.
Okay, thank you.
Yes, sir.
I don't have any other questions, Commissioner.
Excellent. This being a non-voting item, it doesn't require board action at this time, but I just finally want to thank State Board of Education as well for, I forgot to mention in our last agenda item, for their assistance with HB3. The legislature, when putting together that legislation, didn't fully, in my opinion, account accurately how they were going to derive these sources of revenue. And once again, it was the State Board of Education and the GLO coming together to help fund that shortfall. So we've done that in the last biennium. We're doing it again with today's action for the next biennium. So I thank everybody on this call, and particularly want to thank our board and incredible staff for helping make it happen today. We are hereby adjourned.